Sandeep Sabharwal joins us, and lots to talk. Lots to talk. Can you hear me?
Yeah.
What could MPC do to the markets today? Could it be a big swing event, 2-3% here or there?
It could be. I think on the upside, they could actually generate significant upside if they take, like, the rate cut assumption is already there. So I think everyone is expecting a 25 basis point cut. But I think if they address the liquidity issue in a more durable manner, then I think it should be taken very positively. Because at this point of time for the economy, the liquidity is much more important than 25 basis point repo cut here or there. So I think that's the critical thing. My guess is that they are well aware of that and they should be taking some strong measures. So I think that will be the critical thing to watch. So if the policy is growth supportive, then my guess is markets will take it positively.
Lots of numbers, Sandeep, yesterday. And with the standout one when I say standout one, bad numbers also stand out. The standout one or the standout group for me actually is cement and construction. Everything there is just getting marred because of slowdown in the government action.
Yeah, exactly. So I think it's across the board. You see capital good companies, you see infrastructure companies. Across the board, there is a slowdown in execution. Many of the pet projects of the government, like few companies who are doing these Jal Jeevan mission projects, also they have indicated slowdown in payment, and as such, they have slowed down the projects. So I think it's a vicious cycle where the governments don't pay you on time. Then these companies are now very cautious because they have taken a hit in previous cycles. So then they slow down the projects till their payments come through, and I think that cycle's gone through. So, and that's also reflected in the stock price correction. So I think many of these construction, infrastructure, capital good companies have corrected very significantly from 52-week highs to 3-4 months back. They are more near 52-week lows. Many stocks are down 30 to 40% also. And the key is that many of them have good order books. So as if execution picks up, which it should next year, because next year there are no real disruptions, then I think things should stabilize. So longer term outlook of many of the companies remains good, but in the short term, the growth has got severely impacted.
Out of the numbers which have come out, Sandeep, from the large cap space, there is Bharti, there is ITC, there is Britannia, there is Hero MotoCorp. Which one stands out? Which one do you think becomes this go-to stock and you either own it or you plan to buy it?
I think it's 3:1, good to bad. So among the four companies you said, so ITC numbers were the only ones which underwhelmed because the margins were much below expectations. X of that, I think Hero MotoCorp numbers were good. Britannia numbers were very good. The expectations were muted, but I think they are delivered much better in the context of what's happening in the consumer industry. And the best, obviously, was Bharti. Like when the management used to talk of a 300 rupee ARPU 2-3 years back, it seemed very unbelievable. But I think they are well on the way to that. And telecom is a very beautiful business, or so on both sides, because what happens is that the operating leverage is so high that every increase in ARPU just goes into your bottom line, and that's what is getting reflected. So I think Bharti remains a story of improved ARPUs and better than expectation revenue growth, controlled cost, deleveraging, so reduced interest costs, and as such, they outperformed on earnings. My guess is that they will keep on outperforming on earnings over the next 2 years, with what most analysts are expecting. So I would think that this was the best result of yesterday. We own both Bharti and Britannia among these companies.
So, among all these superlatives that you've used for Bharti Airtel, how much do you think is already in the price?
I think analysts tend to be conservative when the company is in upturn and they don't understand that. So I think most of the people are underappreciating the operating leverage that the company has. and the deleveraging which is happening, which is leading to reduced interest costs in a very high capital intensity industry. So, so I would say that it's a cycle thing. So you keep on holding the stock till the growth starts tapering off, and they will keep on outperforming on earnings. So I don't know what will be the final stock price or what should be the target. But what I know is that it will be able to deliver double digit returns, maybe teen or higher than that returns over the CAGR over the next 2 3 years.
Sandeep, let me come to you and let's talk about the chemical space. Given the fact that last 3 years, most of these companies actually reported or rather given muted returns. What's your take coming in on the chemical space now? Because now you have the tariff talks once again. Do you think the China plus one strategy will be at play again?
China plus one strategy has not worked out so well across most of the industries, if you look at it in terms of a holistic basis. However, I think I have observed the chemical company results this quarter, and for some companies, some segments, things seem to be bottoming out, and those companies seem to be coming back. I personally don't buy chemical stocks because of the commodity nature, and I find it very difficult to track each commodity and how it is performing and how it will impact the performance of a particular company. But my general observation is that for many chemical companies, the cycle has bottomed, and for those who actually buy into these kind of stocks, I think there should be opportunities.
For the longest time, everyone has argued that SBI has got its act together. The NPAs are measurable. They're growing in a tough environment. Mr. Shetty spoke about 14-15% credit growth, which frankly is a great credit growth looking at where the industry credit growth is. But markets did not pay too much of attention to that. Am I missing on something?
I think it's all to do with the pre-provision operating profit, which was actually very, very subdued and much below expectations. So I think that's the key, because the advantage of lower provisions might not last. So I think the core operating profit growth seems to be under pressure for a majority of PSU banks, simply because of the fact that they are losing CASA deposits to private sector banks, and the cost of deposits are going up for them. And I think that remains the biggest long-term concern for banks, for the PSU banks. Now, the good part of the financial sector results overall has been that NPAs are very much in control relative to previous stress cycles. So I think they're nowhere comparable. I think the balance sheets of most banks remains very, very strong. And the balance sheet, if the balance sheet has remained strong through a tight liquidity, higher interest rate scenario, then as the monetary policy starts easing, that means that the worst of the asset quality stress could be behind us. And to that extent, the overall financial sector should outperform going forward, especially the NBFCs, which benefit more due to the rate easing cycle. But for PSU banks specifically, their loss of market share in deposits is the big concern.
So, what is a better stock, Sandeep? SBI or HDFC Bank? They both have their unique positioning, and they both have the advantages and disadvantages.
So vis-a-vis both, I think HDFC Bank will do much better longer term, simply because as they get things back into place post-merger, they will be able to grow deposits in line with the credit growth, what they want. Their monitoring on NPAs, etc., will be much better. They'll be able to take higher yield assets much more efficiently than a bank like SBI. So I think if it's a choice between just these two, then I think HDFC Bank should do better longer term.
Is it a good time to start buying these brokerage stocks, assuming that markets have normalized, earnings have normalized, and now FY26 would be all about the real business rather than that F&O herd business?
I think volumes could continue to moderate, because last year, if you remember, till the third quarter, the volumes and the growth was very high. I think it will continue to moderate. And most of the brokerages are not annuity businesses, they are more transaction led. So I think if you want to focus on capital market related stocks, the AMC stocks or something like maybe CDSL, CAMS, or these kind of stocks might be better post whatever the correction has to happen, because the valuations of many of these stocks became very, very high. And the current correction has to do a lot with a correction in valuations. So I think the annuity businesses are much better than transaction-led businesses, because in brokerage, I think it's raised to the bottom in terms of the brokerage rate, competitive intensity, entry barriers, etc.
That's the take on some of these brokerage-related counters. But Sandeep, would like to thank you for taking the time out and speaking with us this morning.